I mean, we were bracing for these numbers, especially after what we saw with Alibaba. How bad were they?
Well, so they were bad numbers, and we knew that, but there were some slivers of hope, obviously, and the company stock did rise about 3% overnight on the, I guess, the caveats when you look at these bad numbers, because, yeah, I mean, the Chinese economy is definitely slowing down, or the momentum is slowing down, and that is hurting, obviously, spending. There's the regulatory overhang that is still persisting. It's not necessarily out of the woods just yet. So you had the first ever quarterly drop in revenue, online advertising sales falling by a record 18%. They slashed nearly 5,000 jobs. That's 5% of its workforce, the first quarterly drop in staffing since 2014. So you have those pressures on revenue, pressures on net income, but those caveats are the online advertising was actually a little better than than many analysts had feared. Also, adjusted net income, when you strip out the one-time gains or one-time losses of its affiliates like JD.com, actually fared about 15% better than expected. So that's why the stock was up. Let's spin this forward. Where does Tencent go from here? Well, there's some belt tightening going on right now. Willard Chen of Forsyth Barr Asia says Tencent has tightened its belt. It's no longer that runaway growth juggernaut that we had expected for so many years, as the Chinese tech industry embraces a downturn. Yes, you have to accept that there's a downturn, but are you embracing it? How are you going to do that? Well, given the new realities, Tencent executives say that they're going to focus. Their strategic priorities are going to be international games, cloud software, and WeChat video. Again, financial services, fintech side, still up in the air. Still talking to regulators about a financial fintech holding company license. No progress.
We saw. Yeah, and Steve, we saw Meituan rising in the session after Tencent, I guess, tried to clarify these reports that they were about to divest in its large stake in the company.
Yeah, that's right. So that was the big story yesterday. Reuters reporting that Tencent would hive off perhaps as much of its entire stake, between 17 to 19% stake, $24 billion US, because of this ongoing regulatory scrutiny. Beijing widely believe that they want the big platform companies that, invested so heavily in so many of these startups, which became big in their own right through the heydays in the last decade, obviously the end of the last decade, in this anti-monopoly crackdown that is still persisting, by the way, even though the government officials and regulators have sort of talked up the need and the strength of the platform economy. There's still all these pressures. But again, Tencent's chief strategy officer, James Mitchell, when asked about this Reuters report, he says it is not accurate. Still, Meituan and Tencent were up, as I mentioned, overnight. Meituan up more than 3% as well. But those other companies we talked about that are also owned partly by Tencent, we're talking Bilibili, Kuaishou, Pinduoduo. Well, Kuaishou is listed here, but again, those listed in the ADRs overnight all fell because, again, there is still regulatory pressure, and there could still be pressure on Tencent to hive off these shares.